Most traders read a headline like Algo Fintech surpasses 50 million in AUM and they see validation. I see a warning sign. Let me explain why. When a white label platform scales to 300 or more clients across retail, agencies, and hedge funds simultaneously, the real question is not whether the technology works. The question is whose interests the architecture actually serves. A platform optimized for B2B partner acquisition has fundamentally different incentive structures than one built around trade execution integrity for the end user. These are not the same thing, and the industry has been blurring that line for years. AUM is a vanity metric dressed in institutional clothing. It tells you capital flowed in. It tells you nothing about risk-adjusted performance. It tells you nothing about drawdown governance. And it certainly does not tell you whether the underlying models degrade as participant count scales. More clients on the same infrastructure does not mean better outcomes. Often it means the opposite. It means diluted edge. It means increased correlation risk across accounts that were sold on the premise of independence. Retail traders see headlines like this and assume the crowd has done the diligence. The crowd has not. The crowd follows AUM the way it follows price, reactively, emotionally, without ever examining the structure underneath. So before you trust any algorithmic infrastructure with your capital, I want you to ask one question. Does the governance framework protect the trader, or does it protect the platform's growth metrics? Because the answer is rarely both. And if the platform cannot make that distinction clear, that tells you everything you need to know. We built Valank's core to answer that question differently. Find out more at visionarybeacons.com.